All right, looks like we are live officially. Today's guest is Yonah Weiss with the Weiss Advice podcast, and Madison Speck doing cost segregation and whatnot. And so I think I did your show a while back, and I mean, obviously, I think you're very well known in the multifamily space and whatnot. So I was excited to have you come on. One, because there's a lot of people that follow me or that are part of my network that may not know what cost seg is.
Right.
And then also just learning more about it as far as like when you should do it, when you should not do it, all the above. So, if I'd love to have you give kind of an intro, and then I'd love to know too how you got into this space. I don't know that I know that.
Sure. I mean, a little bit about me. My name is Yonah Weiss, like Seth mentioned, host of the Weiss Advice podcast, and I'm the business director currently at Madison Speck. So we're the largest national cost segregation company, a very specific tax strategy. I'm a real estate investor myself, but have been in the cost seg space for about 5 years. And funny story how I got started. I mean, really. It goes back ever since I was a little kid and always wanted to be a cost segregation expert. I mean, it was like that or the circus. It was one of the two. And no, seriously, I never even knew what cost segregation was until about 5 years ago. And so that's the amazing thing about real estate is that when I started working for this company, and it was really on a whim, an opportunity. I'm the type of person that if an opportunity is presented to me, I will explore it. Right? If it sounds like a good idea. And it was at that time in my life where I was investing, I was doing some brokering on the side, just got into real estate a couple of years prior, and was just open for opportunities to learn and to be part of something bigger. And when I was approached by this company, Madison, which is an incredible company, great people, and they were, looking for someone in the business development side of the business, which is something that I didn't really have much experience with. But I was a teacher for many years. So I spent about 15 years as a teacher. And so I figured this would be a great opportunity for me to just kind of figure out what this thing is and share that with the masses. So, by the way, just got a notification. Your email to join the streamer just came in. So
there you go. Yeah. So what happens when we're live. You never know what happens. All kinds of crazy things.
And so long story short, I've been working for this cost segregation company, and for the past 5 years, what I've been doing is just educating people. So using my teaching background and just sharing what this was. I mentioned I knew nothing about cost segregation beforehand, and the surprising thing was that so too with the majority of people that I spoke to who were in the real estate space, which led me to believe this was a ripe opportunity to just educate people. People don't know what it is, and that was the main reason, and still to this day is the main reason why people don't even use it, because they just don't know what it is.
Yeah, I would say that if you are not if you're not in commercial real estate, you probably don't know what it is, and then even if you are, like, there's so many things that are misinformation out there, or things that that an investor thinks that they know what it is, but then they get it wrong, or it's kind of like not the rumor mill, but it there's just information out there that's not always true. So maybe walk us through define what cost segregation is, when is a good time to use it, kind of some of those basics.
Absolutely. So the main thing you need to know is it is a tax strategy that is for real estate investors. Anytime you buy a property or invest in a property besides for your personal residence, you are allowed to take a tax deduction called cost segregation, or called depreciation. Okay, depreciation just means that you're able to take a deduction based on the principle that property or things go down in value as time goes on. So the IRS says you bought this property for $1 million, you can now write off $1 million from your taxes. Well, not all at once, but over a long period of time. So they've given kind of arbitrary year lengths of time. 27 and a half years for residential multifamily property, or 39 years for commercial properties. What cost segregation does is just that weird name, but the concept is segregating the cost, okay? Taking the cost, that $1 million that you bought, and instead of lumping it all together in a 27 and a half year bucket and taking that equally over that period of time, we can segregate that into different categories, components really of the property that depreciate faster. So you'll have things like the structure, and that's really all that depreciates on the 27 and a half year schedule. It's going to be the majority of the value of the property, like the walls, the roof, the doors, windows, right, infrastructure. But the Other things, for example, personal property, furniture, appliances, fixtures, even wall coverings or window treatments, things like that, anything, even lighting and things that are non-structural, all of those depreciate on a 5-year schedule. So the job of a cost segregation expert like myself, or is a team of engineers that identify what all those individual components are and create a schedule, create basically a form that allows you to take those deductions at a faster rate than just that little bit each year. So it's a tax strategy, which is a cash flow mechanism, essentially.
Yeah. Now, is there ever a time when you shouldn't do it? Or I guess, that's something that we've talked with our accounting group on is, if we syndicate a deal and nobody can really use the passive losses that are created through doing a cost seg, they've advised us not to. Or that, like if you look at like what the tax is, like ours has said, well, hey, right now is like the lowest that the taxes have been in X amount of years.
Right.
If you kind of push it down the road, you just have to kind of like look at everything, because a lot of people I see, a lot of apartment syndicators anyways, everybody's cost seg, we got to do this. Is there a time when you shouldn't do it?
Absolutely. So, like you said, you got to discuss this with your accountant. Got to know if this is the right strategy for you. A few occasions or instances where it may not be relevant or may not be appropriate, or the best strategy is, number one, if you're planning on holding a property for a short amount of time. Okay, because the benefit of cost segregation, getting these big tax deductions, is only going to benefit you during the hold period. Okay, so for example, if you're holding the property for only a year or two, well, when you sell a property, you're going to be subject to what's called depreciation recapture tax, meaning paying or subject to a tax on the amount of depreciation that you took. Now, without going too much into that or getting too complicated, essentially the time value of money, which is the benefit of cost segregation, is less so the shorter amount of time you hold the property. Okay, so that's one instance where it's probably less beneficial. A second case is exactly like you said, Seth. If you're not actually having the property make money, or you just want to have a more evenly spread depreciation deduction over the period of time, that's where it's going to make sense for you. Most people who do use this strategy are people who, number one, are more than just a one property person, right? Meaning they're going to want to be buying or investing year after year. And so to use this strategy to pay zero or little to no income tax as long as you can, so basically taking all the money that you could have paid or should have paid in income tax and then just using that to reinvest, that's going to be the most beneficial when you can actually use your savings to reinvest and then just continue to scale faster.
Yeah, that sounds great. Well, another question that I have that we've talked about before is, like, what's the time frame? So you buy a property, so we're in a contract on a complex right now. We buy it, and then we should we wait 6 months? I mean, I've heard different things, and so we've kind of learned as we've gone over the last 4 or 5 years. But when you buy it, how long do you need to wait before you really start? Because a lot of guys will buy it and then they want to start renovating immediately. And the way that we have been advised is that you're basically throwing money in the dumpster. If you buy something knowing that you're going to tear it out, the
Right.
IRS has it kind of like you lose the value of it. Whereas if you let it sit for 6 months, let's say, and then you do it, then you start your renovation, you can take full advantage of that. So is that all stuff that you guys look at when you come and do a study, correct?
Absolutely. You're 100% right. When we look at a study on a new acquisition, we can take or identify what all those components are on the acquisition itself. Okay, so you can take the benefit and get those deductions right up front. However, when you just rip everything out or you do a renovation, you're going to be losing a lot of the benefit of depreciating those things because they were never been placed in service. So that's why it's important, like you said, Seth, to figure out what's the plan. Am I going to renovate? Should we start that process immediately? And maybe on everything, or maybe just staggered. And a lot of people with especially large multifamily projects are going to do it anyway staggered, meaning they're going to be renovating units as they become vacant. So you're still going to place the property in service, be able to take those tax deductions up front. But if you don't, wait, like you mentioned, you're going to be actually leaving a lot of money on the table when it comes to those tax deductions.
Yeah, no, that's great. That's great. So how does it work because I've never done residential, so I went straight into multifamily. That's all I've ever done. But how does it work or what would the benefit be for somebody if they went and bought a 4-unit property or even if they have a portfolio of single family houses? Like what does that look like for them?
Same thing, right? As I mentioned, any property whatsoever can benefit from cost segregation. The amount of that benefit is always going to be proportionate to the purchase price. So there's going to be less benefit when you're dealing with smaller properties. However, anything, what I'm seeing, especially when you're dealing with Airbnbs or things like that, when you're have a large cash flow, you can get a lot of benefit from it, even though it's particularly a smaller property. Anything, my general rule of thumb has always been, anything over $500,000 purchase price is a no-brainer, right? The amount of benefit in comparison to that cost of getting something like that done is far greater. I mean, like 10x greater at least when you're doing like $500,000. But even on smaller properties, if you're talking about a $200,000, $300,000 purchase, I would say check it out, look into it. You may have enough benefit that it's going to make a big difference. However, when you're dealing with smaller properties, even if you have a portfolio of single families, unless they were purchased together as a portfolio, you're going to have to do them individually in terms of the cost segregation. And so the benefit's going to be much less and probably not worth it in that case.
Now, is that part of like the cost study that you guys will do? Like, do you guys, if somebody calls you, will you guys kind of evaluate the property or evaluate the scenario or the situation that they're in, and then let them know, hey, this is going to be beneficial or it wouldn't, or do you guys kind of do like a consultation to see, if it before they have to kind of take the plunge, they'll know whether or not it'll work?
Yeah, we do. We always provide an upfront, a free estimate, a free analysis for any property. So you can know ahead of time what the potential tax savings would be on any property. So we have, like an intake form, just put in some basic information, and you're able to take, a pretty good idea once you have that of how much it's going to cost and what the potential benefits are going to be. We always project conservatively, which means on our estimate, you'll always know this is the bare minimum of the tax benefit that I'm going to have if I do this. So it's
Okay.
very, very useful in that case.
Yeah, no, that sounds great. We got a question from Matthew. What are the strategies for dealing with taxes when the recapture happens to at deal exit?
Yeah, excellent question, Matthew. This is a very common question, very important topic. Recapture tax, as we mentioned, is the tax you're going to be subject to on the sale. It's considered a capital gain. It's unrealized gain, which means just like capital gain, if you made a profit on the sale, you're going to pay subject to a tax on that amount. So too, if you made if you took depreciation, and everyone takes depreciation, you're going to be subject to a tax on the amount of depreciation that you took. If you're doing cost seg, you're going to have a larger amount because you've taken a large amount up front. That's really important before I answer your question, just to understand what it is, because there's a lot of information out there on what it's not. People think recapture means I have to pay back all the depreciation that I took, and that's simply wrong. Meaning if you take $100,000 of depreciation deduction, I have to pay back $100,000. It's simply not correct. Again, just to clarify, it's subject to a tax on the amount of depreciation taken. That tax is actually split into 3 different tax rates. So it's not a straightforward thing. Some of the amount is going to be taxed on a capital gain tax rate, right? Some amount is going to be taxed on your ordinary income tax rate, which is going to vary depending on your individual portion. Now, to get to your answer, Matthew, what are strategies for dealing with that on the sale? And this is really important. There's basically 3 main strategies that I see people use that you can use to get around or help to reduce that depreciation recapture tax. So the first one is the most famous, which is a 1031 exchange. This is less common when you're dealing with syndications because it's harder to do. However, it still can be done in certain scenarios. But a 1031 exchange is a strategy that not only defers your capital gain tax, but defers that unrealized gain, that depreciation recapture tax on the sale. And that's essentially, if for anyone who doesn't know what that is, a 1031 exchange is a tax deferred sale of a property by exchanging one property for the other, for a second property. And there's a lot of rules that go into that. You have to fill out forms and hold the money with a third party, with an attorney or escrow in the interim. The second most common strategy is simply what I like to call a lazy 1031 exchange. Okay, and this is when you can't do, or you don't want to, or you're not able to do a 1031 exchange, and you just sell a property outright. Well, when you sell, again, like we said, you're going to be subject to that capital gain, that recapture tax. However, if you buy another property in the same year as the sale and do a cost segregation on that new property, you may have enough losses, enough passive losses to offset the passive gain from the sale, because the gains are considered passive gains. The passive losses from depreciation can offset or reduce those passive gains. So again, lazy 1031, you don't actually have to do it, and you can not only defer those taxes, which is actually better, you can actually reduce it, offset it, meaning wipe it out. So it's not something you're going to have to deal with at a later time. Okay. However, not everyone wants to do that because, like I mentioned earlier, the tax rates are different. And so the tax rates that depreciation can be used against, excuse me, is your ordinary income tax rate. And that's great, right? Income tax rate is a higher rate usually than your capital gain tax rate. So using one like higher deduction to wipe off a lower tax is not necessarily the best strategy. Make sure to speak with your accountant to check that out. The third most common strategy, or I would say less common actually, but third strategy that I know of is something called partial asset disposition. So partial asset disposition is, like I said, a little bit less common, but what it says is that every individual component that depreciates faster, once that timeline has finished, there's not going to be any value left in that thing. For example, when we're doing a cost segregation study, we're going to identify appliances and furniture and all this kind of stuff that depreciates on a 5-year schedule. We come in and identify how much the value of those things. So we say appliances, there's $10,000 worth of appliances here, right? When you sell the property, if 5 years has transpired, there's no more tax value to those appliances, which means if you do this form, which is called a partial asset disposition, you can apply zero value now. It's not an automatic thing, but again, it is something that a lot of accountants do. And even after 3 years or 2 years or even 1 year, some accountants will do. It's a little aggressive to say that after 1 year, there's no more value in these appliances or less value when it's really a 5-year depreciation. But that's neither, that's something you want to discuss with your accountant. In short, just to make it simple, your appliances after 5 years have no more value. You apply no value to it. Guess what? No recapture tax on that value because you've already taken it off the books. Okay? Recapture tax is only going to be on whatever depreciation is still on the books and has been reduced. So again, those three strategies, 1031, the lazy 1031, and the partial asset disposition, it can be done. Do not be afraid of the recapture tax. Just use it as a strategy.
Yeah, no, that's great. That's a great answer. So hopefully that answered Matthew's question, which I think it did. I got one for you though, is that if a lot of people will talk about doing the cost seg within the first year of the acquisition, but what if you've not, like, what if you've had the property for a year or 2 years or 3 years? Can you, is it still beneficial to do it?
Yeah, not only is it still beneficial, but a lot of people don't even realize that you can still do it. A lot of people think you have to get it done in the first year, and that's actually not true. There's something we like to call a look-back study, or catching up whatever depreciation you missed. And so this is really important for people who may have owned a property for a year or 2 or 3 or 5 and never did cost segregation. Like we mentioned earlier, this is a great strategy when you need it. Okay, it's not necessarily going to be for everyone all the time. So what happens at, let's say this year, you happen to have a large, tax burden, right? You're going to have a large amount of income, or you're going to sell another property and you're going to be faced with that recapture. Well, guess what? You can go and do a cost segregation on another property you've owned for a number of years and catch up whatever depreciation you could have taken that you didn't take. So like you said, you can take, a lot of depreciation upfront in the first 5 years. Well, let's say 5 years has passed. You never did cost segregation. You can now this year get like a lump sum of all that 5-year depreciation this year. So it is a strategy, look back study. People can get it done at any time.
Oh, that's interesting. Yeah. That's what I mean, is that there's so much misinformation because a lot of people think that you can't, like, if you've missed it in the first year window, you're done, or it's not as beneficial. And so I think that's great to know that you can do it at any time. Really, it just depends on kind of how, again, it would be your guidance and the folks that work with you. So, that's something that I'm curious about too, is like if somebody wants to reach out to do this, what's the best way that what's the process look like for them working with you guys? I'm assuming that, you're obviously one person, you can't take everybody's phone call. So how does it work? If they want to reach out and have the company do the cost seg, like, can you walk me through kind of like the process from, kind of start to finish, or at least start to, hey, here's what we found the value would be, and then how it kind of works from there?
Absolutely. So yeah, like you said, I'm just a one man. We have a big company, Madison Specs. Like I said,
A super popular man, by the way. I mean, I would just jump in there and say that I would say you have very very like the way you have done social media the last few years has been amazing. I love watching it. I mean, I remember when you started, kind of hearing about you and seeing you and whatnot, and just how you've grown is amazing. So, not
Oh,
to
I
get you off
appreciate that.
track.
No, thank you very much. Just to speak on that for a second, it's really just about consistency. You don't run a marathon just by, taking off and not having any training. It just comes little by little every single day, right? You get good at something by just consistently taking action and learning along the way. So that's really what it's all about. But to go back to your question, how to reach out, Madison Specs. You can just go to our website, Madison Specs. You can find me on any social media. I'm pretty active, and so I can get to you there. You can also go to my website, yonahweiss.com, which is my personal website. It talks about what I'm doing also besides for just the cost segregation, but we'll have info there as well. So those are 3 easy ways to get in touch with us. And like I mentioned, there's so much benefit. And if you never knew about this or you wanted to take an opportunity, there's a free estimate we always provide. So it's just a no-brainer just to at least get some more information and to make an educated decision whether this is going to be good for you or not. And unfortunately, there's a lot of accountants out there, CPAs, that don't even know about this or don't really understand how cost segregation works. And so it's unfortunate that I get people coming to me all the time saying, how come my accountant never told me about this? Or my accountant says this is not a good idea. This can only be done for large, $10 million commercial properties. And it just goes to show you that, like you said, Seth, there's misinformation out there. Even though this is a tax strategy, even accountants, because they may not specialize in real estate, aren't aware of this or aren't really up to speed. So it's important to learn on your own, right? Watch podcasts or videos like this and just reach out, to ask more questions to those people who know more.
Yeah, for sure. And I would say that to anybody watching is to really understand the accounting and the financing piece is such a big deal as you scale, and realizing that you may outgrow the person that you've been with over time, because I think we've been through 3 or 4 groups now, and it's for stuff like this where when we're having to go to them and tell them what cost segregation is and explain it to them and why we think it's beneficial, and they don't have an understanding of it, like you start to believe like, okay, I may be in the wrong room or the wrong accounting group when we're doing kind of like bigger things, because most accountants that I've ran into are great at doing the traditional things or traditional businesses or doing the general personal level taxes, but when you start getting into some of these more, I wouldn't say complicated situations, but more sophisticated tax strategies, a lot of them are unaware, or maybe like you said, they don't understand it, and so they advise you not to do it when really you should be doing it, and especially if you have a larger portfolio.
Absolutely. Yeah, 100%.
Well, and how do you guys do it? If you're like, if we brought our portfolio to you and said, hey, we've got 700 apartments, never done cost seg on any of these, will you guys just look at each individual complex and then do the study for each one, kind of like to decide whether or not it's the right fit?
Yeah, exactly. We will run a analysis on each property, right? Not each individual unit per se, but each property.
Right.
It's a separate thing. If you've already depreciated the property in the past, meaning you've already filed taxes at least once on the property, we're going to need to see your depreciation schedule, whatever was filed, because that's going to determine when we're talking about a look back study, we're talking about going back, we have to look at whatever was put into place in terms of your land value, depreciation value, and then we can go based on that. So yeah, we will take a look at that. We can do an analysis and show you upfront what we think the benefits would be. And so on an individual property basis.
Okay. What do you think are like maybe like the top 5 things or top few things that investors should be doing when they're evaluating a new purchase and they're thinking about doing a cost seg? Like, what are some things that they should be looking at maybe in their due diligence period? Because that's the thing I think that that we do a lot of is kind of like the pre-planning. And so when, if we kind of have a roadmap when we start due diligence, usually you have about, everyone's different, but like the one we have coming up right now, we'll have 30 days to do it. Is there things that is it that the time when they should be contacting you if they know they want to do it or they think that the property would be a good candidate for it? Should they contact you guys early on in that due diligence phase and kind of say, kind of get together with you and work out the plan, so that way if they are going to start renovations, they do it correctly, they to maximize the value?
Absolutely. Yeah. It's never too early. I would say, unless you're just like thinking about investing, but once you have a property under contract, once you're, or have closed on a property, that's already a good time. But like you said, when you're doing due diligence, a lot of people want to stick that in and figure out, well, what's my after tax, income going to be? People will put in all the metrics and all the underwriting and then not factor in what their income tax is going to be on that, because it's hard to figure that out, especially when you have multiple investors. Everyone's going to be on a different level. But if you can factor that in as well, it can actually show you what the real cash flow will be, as opposed to your pre-tax net operating income.
Right. Yeah.
And that's actually something a lot of banks and lenders would like to see as well, because they're always going to be looking at what's your debt to income ratio. Well, if your real income, meaning your cash flow, is more than what it just shows before taxes, because you're going to do a cost segregation and have less income tax, that's actually better for you. So you can show, I'll have more actual cash to apply to this loan or to the debt service.
Yeah, no, that's great. I've never had a lender ask me for that, but that makes total sense to do that early on, and then have them at least be able to show them the study up front, or kind of like the quote, if you will, so they can kind of see what it would look like.
Yeah, 100%.
No, very good. Well, I don't have a whole lot of else, to go over with you on this stuff. I mean, like I said, we are looking to do several for the portfolio that we have, so I'll be in contact with you for sure. I don't know if anybody else has any questions for you while we're doing this, but I appreciate you coming on, and I appreciate the time. I know you're, like you said, super busy. You're a highly sought after individual by a lot of folks. So, I think it's great. And, I appreciate you coming on and chatting with me today.
Happy to be here. I'm glad we're able to do this, Seth.
So, yeah, absolutely. Well, if there's no other questions from anybody else, I don't have a whole lot left to ask you. Like I said, I know that we're looking to do it. You've covered a lot of things that I either believed or have been told that was not accurate. I think that's the biggest thing is kind of understanding the timeline of things,
right?
And knowing when you buy it, you start doing your CapEx, how long you should wait, and all those things that you guys cover. Because that's the tough thing, I think, too, for investors is there's a ton of companies out there that do this, but like, and kind of like weeding through the people that are, I don't know, I wouldn't say like legit, but like, you don't know who to call. Right. And most people, it's a relationship business. And so, that's the part of it why I loved it. I wanted to have you on, because you've worked with so many different investors that I know, and you guys have performed very, very well. And everything that you've said you would do, you've done. And that's such an important factor. So,
Right.
I mean, I wanted, those that are watching that maybe haven't done one or been considering it, that they would know, to be able to get a hold of you guys.
100%. Yeah. And if you guys are watching this live anywhere where you're watching this, you can just follow me or connect to me on whatever platform that is that you're watching. And like I said, I'm pretty active on most social media, but especially LinkedIn. So if you guys are watching LinkedIn live here, I do see there are a few people watching live.
Yep.
Make sure to connect with me, and we can follow up after that.
Yep, absolutely. Well, Yonah, I appreciate your time, and you have a great day. We'll talk to you the next time. Thank you.
Awesome.
Bye.